Hey there, everyone. Happy Monday, March 17th. Happy St. Patrick's Day, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully cool and overcast Redmond, Washington. Great to be joining you today here on a Monday afternoon. First day of the week after last week's really tumultuous week. Last week, Monday, one of the biggest down days in recent memory. Friday, a resilient up day. Today, bit of a follow through to the upside after Friday's rally phase. We're tending to label this current move as a counter trend rally. A day like today, though, the S&P 500, over 90% of S&P 500 member stocks up today, right? Advancers far outpacing decliners by most with most of the indexes that we track. Less encouraging for the Nasdaq, but for the most part, way more stocks up than down, and that continues the strength that we saw on Friday. So what does this mean for the overall picture? We're going to dig into the chart of the S&P 500, talk about some key levels to reflect on. We'll look at some of the breadth and sentiment conditions that have evolved a little bit, particularly volatility. And then finally, we'll look at some individual stocks on the move. Continued rotation, continued uncertainty as always. And before you get too excited, just bear in mind real estate was the top performing sector today. So it wasn't back to offense all across the board. With that in mind, let's get to our market recap and see how things played out today. So the S&P 500 rolled over a little bit going into the close, but really the bulk of the gains had been established by then. The S&P hit a peak just over 5,700 today, but did close slightly lower around 5,675. So we're bouncing off nicely off of that 5,500 level, which was right about where we hit a low last week. So again, based on the fact that in the last couple of weeks, after breaking 5850, 5,500 was kind of our line in the sand, kind of downside target. Once that's reached, would be amazed if we didn't get at least some sort of counter trend bounce to the upside, as many would call it, the dead cat bounce. And so that's how I'm generally thinking of this current move from Friday now into this week. I could be convinced otherwise. We'd have to see a lot more structural changes than we've observed so far. And again, I'll let the breadth indicators and other charts do the talking. But for the most part, that's kind of how I'm seeing this. The mid cap and small cap S&P 500 index is all positive. The mid cap index was the best performer today, up about 1.5%. The VIX moving slightly lower, about 1.3 VIX points to the downside, still holding above 20. Which is our sort of basic cutoff for high volatility versus low volatility. VIX above 20 means reason to be concerned because of because of elevated volatility and therefore elevated uncertainty. VIX below 20 says calm down a bit. Things are not too bad. We're kind of getting near to that point where it would be sort of a deep breath of, okay, things are not that bad. But a VIX holding above 20 would be kind of a negative development here. Looking at the fixed income markets, then we'll look at commodities and cryptocurrencies. I mean, bonds, not much of a change to the 10-year and 30-year points. They're essentially right where we finished the week on Friday. So the 10-year yield around 4.3%, long bond yield around 4.6%, 5-year point around 4.1%. So we still have a normal shaped yield curve, but depending on how you measure it, still kind of getting back to that slightly inverted sort of position. The TLT, which is a treasury bond ETF, long duration treasuries, up about 0.5%. And that's actually interesting because stocks and bonds have been moving inversely to one another quite a bit recently, actually. Going into this year, it was sort of stocks strong, bonds strong generally. I mean, as a general trend, certainly at the beginning of this year, that's sort of how things played out. Then from mid-February, then to mid-March, stocks down, bonds up was sort of the general trend that we've observed. So today, kind of changing that, and both stocks and bonds moving higher through the course of the day today. It's worth noting, by the way, if you look at the chart of the TLT, it opened very strong, but in the afternoon kind of came down a bit, still up about 0.5%. The dollar index, no real significant change. I mean, down slightly from Friday. The general trend in the dollar has been weaker. I did grab a chart of U.S. versus non-U.S. markets that I want to share with you. That weakness in the dollar year to date has really changed, among other things, has really changed the dynamic of U.S. versus non-U.S. I mean, going through the end of last year, 2024 was a U.S. over non-U.S., not even close. I mean, there are very few markets that looked better than the U.S. markets, maybe at times India and others, but generally the U.S. the strongest place to be, particularly for U.S. based investors. because of the strength in the dollar, and just because of the weight of the U.S. market so geared toward that AI trade that worked so well. Now in 2025, very different. Non-U.S. markets are actually doing quite well year to date. So while here in the U.S. it feels like a raging bear market of sorts, where we're down 10% off of all-time highs about a month ago, a lot of non-U.S. markets up decent amounts year to date. And we'll look at that chart here in a little bit. So again, if you've been ignoring your non-U.S. exposure, I think that's a great reminder that that being naked non-U.S. stocks can be great until it's not. And I think this is one of those times when it does not pay you to be ignoring some global markets. A number of them, by the way, bouncing up, like Mexico, Brazil, and others, which we'll look at. Looking at the commodity space, I mean, commodities continuing to impress here, right? I mean, in 2025, kind of continuing the strength that we saw, particularly in precious metals. Gold up another 0.5% today, at or near new all-time highs. Gold futures pushed about $3,000 an ounce last week for the first time. So we're seeing continued strength in that area of the market. Now serving as a bit of a safe haven, I would say, although they were strong much of last year as well. Crude oil prices slightly higher today, and energy actually ended up being the second best performer on the sector list. And overall, pretty decent moves there. Looking at cryptocurrencies, all in the green today, with the equity markets moving higher during the equity trading session. Crypto's kind of moving in conjunction there. The Bitcoin is up about up to about 84,000 and change. That's up just about 2% from the end of the previous 24-hour period. Over the weekend, you saw I move up to around 85,000 on Bitcoin, got down to around 82,000. And then, during the equity session, really pushing to the upside along with equities. Ether prices getting back toward $2,000 and got to around 1950 over the weekend. Traded up to there just shortly before we're going live here. So overall, cryptocurrencies showing some short-term strength, still well below the high watermark that we set earlier this year, but generally trending in the right direction here. Looking at the 11 S&P sectors, we can see all 11 of them finished in the green. So decent up day. However, the leadership was not a feel-good, back to normal kind of move. I would say this is a new normal we're experiencing in the last month. For sure, 2025 has been very different than 2024, but the last 4 weeks have been even more significantly different, with obviously a 10% haircut for the S&P. But today you're seeing a nice bounce to the upside, but real estate, a fairly defensive sector, is number one at the top of the leaderboard here, up 1.8%. Energy number two, up 1.6%. Consumer staples number three, up 1.5%. So sort of a defense kind of cyclical leadership to the markets here. You have to go down here to communication services, fourth from the bottom, for the best performing, Mag 7 sector. So the bottom performer, the XLY, managed to make it an up day, which is good, up about 0.2%, so not by much. Tesla back in the on the downside today after some decent bounce last week. Utilities second from the bottom. One of the other fairly defensive sectors, 0.4% higher. Tech and communication services both up about 0.7% today. That'll round off the bottom of the leaderboard. As a reminder, we did do an all mailbag episode on Friday. A lot of fun. And listen, I can't thank you guys enough for sharing some really thoughtful questions through the course of the week. I get to a couple when we can on the show, but that mailbag episode on Friday has turned into a really fun exercise. And again, I have plenty of really good questions from all of you, and I appreciate you sending them. Please keep it up because it makes the show really dynamic and interesting and different every week, which I'm thankful for. But one of the things we talked about in a brief market recap before we got to the Q&A on Friday's show was just reminding that our market trend model is now in a bearish configuration. The long-term model is still bullish for all the U.S. markets, and that's more of a secular measurement. That's probably going to stay bullish for quite some time. We'd have to have a significant drawdown before we would even get close to turning, bearish. That's just how it's designed. But the medium-term time frame for me is the main one to think about whether I want to be more risk on or risk off. Do I want to be adding risk to the portfolio or taking risk away? Is the general way that I think about that medium-term model. So not last Friday, but the Friday before was when the medium-term model finally turned negative for the S&P 500. That's the first time it's been bearish since the end of 2023, kind of going into and coming out of that major low in September and October. So it's a big deal in my work that the medium-term model is back bearish after being bullish through all of 2024. One of the things that just reinforced don't be too negative, don't be too negative, because the medium-term trend is positive. Now the medium-term trend is negative, which tells me don't be afraid to get more negative, because that's kind of what the evidence is telling me. Still more to share there as price goes on, but one of the maybe configurations to think about, if we do get a decent counter trend bounce, we could get one of those situations where the short-term model turns back bullish, medium term remains bearish, long term remains bullish, which would be sort of a classic counter trend bounce within a new bearish phase. So something I'll be looking for as early as this coming Friday. Here are the breadth conditions that I mentioned. Just want to mention the S&P 500, 91% of S&P 500 members in the green. Now, I don't know a lot of people that use that particular measurement, use the S&P index as the way of declaring like an official 90% update. I'm thinking of legendary technical analysts like Walt Deemer, who was at Putnam Investments for years and years, still sharing things on social media, which is so cool to see. He would use the New York Composite Index, which is a broader universe, better representation of kind of the equity markets, particularly when you're looking at an equal weighted measure of strength like that. So 90% update in the New York Composite Index would be a big kind of green flag telling you this is a big uptrend move, a big sign of additional buying coming in off of weakness. Not quite there, but for the S&P, the mid cap index pretty close to around 90% up. So just tells you most things are moving to the upside today. But look at the gap between the S&P at 91% advancers versus the NASDAQ Composite, which is 66% advancers. That's that gap between sort of large cap with a broader growth versus value universe versus the NASDAQ, which is more of the growth part and not a lot of value. So certainly value the place to be, at least today. All right, looking at the Magnificent Seven and Friends mega cap leadership names, Netflix up 3.5% today. Good up day for Netflix for sure, and clearly an outlier relative to the rest of the Magnificent Seven, the rest of which were kind of flat for down. Apple up about 0.25%, Microsoft flat. So two of the big technology names just slightly higher. But NVIDIA, the third big technology stock, down about 1.8%. That's not as bad as Tesla, down about 4.8%. Tesla's trading like a cryptocurrency now with more accelerated swings to the upside and the downside. So if you love volatility and you're not getting enough volatility from cryptocurrencies, hey, take a shot at Tesla, because there's plenty of vol there right about now. Amazon slightly lower, about 1.1%. So two of the big XLY weights, Tesla and Amazon, both down today while the benchmarks were up. That's part of why consumer discretionary, not a great place to be on this particular trading session. All right, let's get on and look at the market carpet. As a reminder, I do see some questions coming in on our YouTube channel, on X, on LinkedIn, and Facebook, the four platforms upon which we are streaming. Let's get the words out on a Monday, Keller. So thanks so much for tuning in live. Those of you that are doing show, I appreciate you asking questions as we come along. And I'll take a question or two at the end of the episode. All of the questions we don't get to, we will put into the mailbag. We'll do an all mailbag episode on Friday. We'd love to feature one of your questions on the show. So please, as we go along the review today, drop your questions in there, and I'd love to feature it on the show this coming Friday. Looking at the market carpet, I mean, pretty decent update, right? And if you sort of tune out NVIDIA, Amazon, Tesla, Alphabet, Meta, which were down slightly, and look at the rest of the heat map, pretty decent day, right? I mean, a lot to be excited about. As you saw from the breadth indicators, most stocks up today, and certainly the heat map representing that. I'm particularly noticing some renewed strength in financials. This has been a sector that's been struggling as of late, and certainly in the last couple of weeks, we've seen some of those financial stocks that have been quite strong, like Visa and MasterCard come to mind, pulled back quite a bit, having a nice upside bounce today. Berkshire's an outlier in that it just kind of just keeps going up like nothing else is happening. But, others like Blackstone, Morgan Stanley, these are all names that had pulled back. BlackRock, of course, these are names that have been coming down in the first quarter. So something to watch to see if these charts like Apollo Global, which have been really underwhelming charts year to date, can start to turn higher. That was really the story, going into the end of last year. And some of those have held up okay, but it's sort of everything outside of kind of banks and money management, right? I mean, the things that have done so well are like insurance companies, payment processors, exchanges, these are the stocks like CME making a new all-time high again today. And these are just kind of up and to the right, nice consistent uptrends in these charts. So would be interesting to see if some of these other names that have been struggling, like Morgan Stanley, like American Express, like Bank of America, can start to get a bit of a rotation higher. Sort of started that here going into today. We'll see if that's able to continue. Of course, I'm looking at healthcare, industrials as having nice up days with plenty of green on there. But defensive sectors as well, right? Real estate, consumer staples looking really good, and that's not bad. I mean, if ever in a healthy bull market phase, like even consumer staples are probably doing okay. They're just underperforming on a relative basis. But again, I think we'll see if there's a sustainability to some of these moves. I think with consumer staples, the challenge is so many of these charts have just been so bad for so long. Like Lamb Weston, I saw was one of the top performers in the S&P. I mean, it's up 5%, but it's still down a ton in the last 12 months. I mean, it's at 50% of its value from a year ago. So how excited do you want to be about a 5% up day after a 50% loss? I mean, I guess a little, but not great. And so that's, we have to remember, as I've mentioned many times on the show, the benefit of looking at the heat map is to just see what's happened today. But part of what we focus on in the show, which I hope you're able to do within our discussion, but also outside of it, is connect what we saw today. Think of it as incremental new information that you then connect to the overall trend. So things you can do just on the heat map, look at like year-to-date percent changes, right? If you feel yourself getting really too bulled up because you're looking at all the green there, look at year-to-date and recognize that this nice update comes, again, within the context of a pretty rough, last 4 to 6 weeks. Just looking at the 1 month changes and then thinking about what the 1 day change means versus the last month, that's where things can be put into context. I think one of the great benefits of charting is that it gives you context. So you're not just looking at one moment, you're looking at the trend over time. So what we do here, looking at the heat map, is a quick version of just understanding what we learned today. But the chart analysis is where you want to get to, right? Looking at the charts and looking at the trends and understanding how 1 day moves in something like LW or a little tiny blip after this big long-term downtrend. That's what you want to understand and appreciate. I'm sorry we don't have time in a brief market recap show to go through all of that sort of thought process with a lot of these individual names. But we're doing the best we can to keep things updated. I guess on the market carpet, that's about it. The other thing is the very first thing I said was, if you ignore NVIDIA, Amazon, Tesla, Alphabet, and Meta, and Microsoft, right, and Broadcom, these are the big names that were down, then everything else was good. Here's the problem: is our benchmarks have a lot of weight in Alphabet, Meta, Amazon, Tesla, Microsoft, Broadcom, NVIDIA, all those names that I just mentioned. So the fact that you see those kind of flat to down tells you a lot, I think, about the general vibe that we have here with growth names just not sort of accelerating to the upside in a way that would make me feel really confident about a nice strengthening uptrend. As we get to the chart review, I just want to let you know, I always try as much as I can to share some of the content I'm putting in different places. I actually just put a video up on the Stock Charts TV YouTube channel. I'm not sure if it's up quite yet. Probably not, but should be up later this evening. I do a weekly show every Monday over at Stock Charts TV, and we did a choose your own adventure style video on the NASDAQ 100. You basically will go through 4 different scenarios, talk about what they might look like. You watch the video and then vote on which one you think is most likely. It's really helpful to kind of force yourself out of your biases and force yourself to think about different potential next steps for the NASDAQ 100. We can also go back to the last video that we did, which was in mid-December. Talk about an interesting time. We ended up putting the video out right at that peak in December, so you'll see how things actually played out very closely to one of those scenarios, and should be a lot of fun. So make sure you check that out on the Stock Charts TV YouTube channel. If it's not up right now, it should be up later this evening, I would hope. All right, let's look at the charts here, and then we'll take a couple questions, and we'll be done for the evening. Looking at the daily chart of the S&P 500, I mean, again, my initial thought, I put a lot of value in when you put the chart up, what's sort of like your initial takeaway. And I found, having spent a lot of years teaching people how to do technical analysis, once you learn the building blocks and once you have a pretty good checklist, a process for analyzing charts, your ability to look at a chart and very quickly just assess the conditions and think about what it means, it happens very, very quickly. And so for me, the initial assessment is this definitely feels like a counter trend rally. We've reached a key level of support, which we projected from back here. I mean, once you hit a top and you start pulling back, you start thinking about downside objectives. That's where 5,500 comes from. We almost got there exactly a couple days ago. From there, we've bounced. And so that makes a ton of sense. Being oversold as we reached an objective, kind of reasonable to get a counter trend bounce. So where do you bounce to? Most likely the 200-day moving average. I mean, I feel like market history is filled with examples of the 200-day being broken, tested from below, and then the next big leg down. I can't guarantee that's what's going to happen, but that's sort of how this is playing out. That would be a very reasonable expectation after what we've seen over the last couple of weeks. I would say beyond that, I mean, you have the 200-day, you have the 38.2% retracement level. I would say all the way up to 58.50, to be honest, for me, I think fits into this sort of bearish general trend. And I don't mean to keep pointing down to like 4,800. I'm just kind of getting down to in that direction. So this is not implying a downside objective there. But I would say a counter trend bounce and then retesting that low would make a lot of sense to me over the next, 3 to 6 weeks. And then the question, right? The question points would be, when we rally, how high do we get, and what are the conditions as we get there? Do we see the RSI moving back toward like 60, which would be a reasonable place to fizzle out? Do we see the breadth conditions improve enough? Do we see leadership rotation in a way that it looks like investors are putting on a lot more risk versus just kind of counter trend moves? And at this point, that's more what it looks like to me. But if we break above 58.50, I would not be very comfortable remaining bearish. At that point, I would probably be thinking we need to go back to the upside and just bet on a retest of the previous highs and follow the momentum up there. But this is plenty of room to have a decent bounce and still be within the downtrend phase. That's generally how I'm thinking of it, just because of the configurations we've observed over the last couple months. So for now, in terms of this week, I think you're framed by 5,500, the low from last week. Does that hold if we pull back? If we continue to rally, does the 200-day hold? And after that, that's when we have to sort of reconsider our thinking. I was sort of in a pensive mood, I guess, as I'm looking through the charts. So I had some random kind of thought-provoking charts, hopefully, and I would say with the equal weighted S&P versus the cap weighted S&P, this is one of the many ways we can think about leadership, ways we can think about breadth. Is just looking at the S&P 500 weighted two different ways, right? The regular S&P is cap weighted, so a lot of weight on those big mega cap growth names. The equal weighted S&P, all 500-ish stocks are equally weighted. So the mega cap overweight is removed, and you're looking at just kind of the movements of those of that group of names and how they're fluctuating. When this series is going lower, when the ratio is going lower, that basically means the mega caps are outperforming and they're dominating. So regardless of what the general markets are doing, regardless of what the direction of the S&P is doing, mega caps are outperforming the smaller end of the S&P. And when this reverses and when the ratio starts going higher, that means that the kind of smaller, really more mid-cap names in the S&P are probably doing better than the mega cap stocks. And that's allowing that ratio to go higher. And that's been happening year to date, right? If you look going into the end of last year, we're kind of at the lower range of where we've been for the last couple of years. All of a sudden, year to date, we're starting to rotate higher. And just in the last week, we finally broke above the 200-day moving average for the first time since the first quarter of 2023. So that idea of mega cap dominance has been so driven into our brains because that's exactly what's been happening for multiple years, which means a change usually catches a lot of investors off guard. And I would say that's probably happened year to date, right? I mean, many investors through the strength of 2024 probably saw their Nvidia, Amazon allocations, whatever you had in those names. If you had bets on those stocks, it becomes a bigger and bigger weight in your portfolio as they outperform so much. And you're certainly seeing a change there. So when that changes and when those mega cap names are no longer dominating, it takes a while for us as investors, for a lot of investors, to sort of change their thinking and recognize that the world is different. I'm seeing a lot of the world is different kind of charts, and this is one of the many I've been able to share with you. is that the equal weighted S&P started to outperform the cap weighted S&P. That tells you you're best served not going to the Mag 7 names, but other things, other areas of the market that we've been ignoring probably for quite some time, like the value sectors we've been highlighting here. The VIX is coming down here, and this is just in the last couple of sessions, right? Midweek last week, we're talking about, getting above that 29 handle, which would be, really a danger zone for the VIX. When the VIX gets above 29 or 30, it's pretty uncommon, right? It does not happen that often. It usually only happens during big periods of distribution. The last time we got above there ended up not being that bad of a move. It was July to August. But if you look back to like the COVID era, right, when the VIX pops up in the 80s, if you look back in 2022, you see big spikes in the VIX, and much of 2022, the VIX didn't even get lower than 20 for most of the year. And so we're starting to kind of get back into that 2022 kind of range. You can see the whole range in the VIX has sort of elevated in the last 6 months. I think this is maybe the new reality as well. The VIX doesn't get down to the low teens most likely, and probably gets above 20 and stays there. That would be my expectation given the volatility that we've observed so far year to date. But something to watch for now, the VIX actually coming back down. VIX below 20 tells you, or at least tells me, don't be that concerned. Low volatility, low uncertainty. So something to observe certainly through the course of this week. In terms of non-US markets, I have a regular process of reviewing ETFs, tracking the global markets. I don't honestly look at local indexes as much as I did back in my sort of institutional days. I worked with a lot of international money managers who were actually investing locally in India or Japan or Singapore. And so we really wanted to understand that the local terms and the local currency differential and all of that. I found now working with a lot more with financial advisors and individual investors, we tend to make a bet in a non-US market using an ETF, right? And it's as cheap as ever as you can ability to access these markets, which is a good thing, I think, for advisors and for investors. Having said that, it's really important to track those ETFs and see when you see some signs of life. Mexico, the EWW, which is the U.S. listed iShares Mexico ETF, back above its 200-day moving average for the first time since May of 2024. This is a market that has been in a pretty consistent downtrend, that is, through much of 2024. Ended up finding a low right after, right going into year end last year, and year to date, it's kind of turned on a dime and kind of pounding out this nice pattern of higher highs and higher lows. The momentum is strong. It's sort of in the bullish range. The relative strength is improving. We're making higher highs and higher lows, and we're back above the 200-day moving average. Maybe a good time to think about something like Mexico and Brazil, which is also back above the 200-day moving average. From a technical perspective, look at what happened to this chart. Coming off of a high in December of 2023, we then start to make this pattern of lower highs and lower lows, a bit of a bounce to the 200-day in August of last year that failed. A number of these tests failed. We then rallied up in January into February, failed at the 200-day. Finally, today, we're closing back above the 200-day moving average. So what you want to watch for in this sort of situation from a technical perspective is being able to regain the 200-day and hold it, right? You want to break above and then follow through. I'm encouraged by the fact that the momentum is now more constructive, similar to what we saw with the chart of Mexico. The relative strength is clearly strong. I think holding the 200-day would be very encouraging for sure, and would validate a likely rotation to more of a bullish trend here. So I think with both of those markets, you're finding across the Americas some interesting bounces to the upside. Now, non-US markets, the one that comes to mind immediately right now is China, which has had an incredible run of strength. I mean, these really vertical exponential rises that have then seen a pullback phase, but they've over the last 16 months have just continued to follow through to the upside, by far outperforming the US market year to date. The momentum overall is strong from a technical perspective. And again, regardless, not commenting on the fundamental stories in China or the economic conditions, just from a technical perspective, the chart is working, and Chinese ETFs that I track are in pretty constructive patterns. Some China stocks are reporting this week. I want to say PDD. I want to say Pinduoduos this week. That might have been last week. Something I could probably look up because I have a charting platform in front of me here that we're all looking at. Why not? March 20th, coming up this week. I was going to say it's coming up this Thursday. So PDD not looking as strong as like FXI, but it's a pretty interesting chart. It's more of in a consolidation phase, but just recently making a higher low, getting above the 200-day on its own. So does earnings with PDD provide further upside follow through for that particular stock? And is that part of the Chinese recovery story? Possible. I actually got questions over the weekend from some of my market misbehavior premium members, one in particular about copper. So we looked at some different charts of copper. Dollar sign copper on the stock charts platform is the copper future, and that's what we're looking at here. But I would say, I mean, again, nice classic uptrend. Again, year to date, how many charts have we seen that had a particular configuration going into year end? In this case, a downtrend in copper just completely changing, right? If you draw a trend line from those major highs, broke into the upside, we stop making new lows, we start making higher highs and higher lows. You could draw a trend line off of these major lows, and it's just a nice consistent uptrend. So, the story in copper is very much tied to demand from China, and this is a, basically an economic growth theme that has been playing out here. Copper is one of those basic metals that you need, industrial metals that you need for things, for wire and stuff. And you're seeing demand, and you're seeing a clear uptrend. Wanted to note here at the bottom, by the way, in purple, that's the correlation, rolling 20-day correlation between copper and the S&P. A lot of people, when they ask about copper, they think copper is a great indicator for the S&P. Like if copper is strong, that means probably things are good and there's more demand. But you have to remember there's a big, I think this is more of a China story right now and not the US. And you can see by the fact that the current correlation is completely inverse. So the S&P is struggling while copper is improving. The relationship between copper and the S&P is not as consistent as you think it is. It's similar to gold. It actually has a fairly low correlation to stocks I've found over time, but something to keep an eye on for sure. Final comment on non-US markets, then I'll look at a couple stocks and take a couple questions. This is just to remind you, year to date, here's the S&P in the bottom, down 3.2%, even with the bounce on Friday and then Monday. Going into the last Thursday's close, down 6% for the year. We've kind of cut that downtrend in half. We're still down about 3.25% for the year, but it's not been a great year for the S&P. The emerging markets ETF, EEM, and there are a number of them. This is just the one that I tend to use, up 8.4%. EFA, which is global developed markets, developed Europe, developed Asia, up about 12% year to date. So it's just year to date return. So the weakness in the dollar, the weakness in mega cap growth that was such a growth engine for the US in 2024, completely changing. And now non-US markets very much showing strength while the US markets are showing weakness. All right, some individual stocks. I want to highlight NVIDIA. This candle pattern, I don't know if you know this one. This is actually called a dark cloud cover candle. What's so funny is on a show like this, I will introduce a chart and start mentioning the candle pattern. And in my brain, I'm thinking, what is that candle pattern? I'm just like trying to go through a couple hundred of them to just come up with it. And thankfully, it usually works. I very rarely will not be able to come up with a name with it. I usually am pretty good with it. You can thank the CMT exams for pounding those into my head, and John Murphy and Steve Nissen's books, which I studied with a lot of effort to get these under my fingers. But this is called a dark cloud cover candle, where you have an uptrend, you have an up day, and then a down day. We open higher, we close at least 50% of the way through the first day's candle. So just barely a dark cloud cover candle. That's a bearish 2 candle pattern. So the next 1 to 3 days are probably weaker rather than stronger. The reason why I point that out here is NVIDIA. Most short-term peaks have been met by candle patterns. So you see a lot of these bearish engulfing patterns at some of the major peaks. I'm highlighting some of those. Like that one was a great one when we tested 150. You'll find some random like doji candles. Is actually called an evening star candle. It's actually an evening doji star, I think you would call that. Now we're really going through the depths of the candle literature, but that's a 3 candle pattern: up day, doji candle, down day. That's bearish. Another bearish engulfing pattern, some doji candles here. So NVIDIA often has had these bearish candle patterns at a major peak or at a short-term peak. We're kind of getting one of those today here, which tells me to think maybe short-term weaker than stronger. But again, the longer-term story with NVIDIA is still kind of this downtrend phase, and I see this as an uptrend within a downtrend channel that we've documented on the show here pretty often. Intel we highlighted, I think, on Thursday's show of last week. I just want to show today we traded higher yet again. We're right at that resistance level. We talked about 26 as being a key level of resistance, right? Intel had this distribution in the first half of last year. Then we found support around 18 or 19. We tested that in August, September, December, January, early February, maybe mid-March, kind of getting back down to those levels. Now we're at the upper end of this range. So this is really just a sideways chart waiting to break. So breaking above 26, I think clears the way to basically get back to the mid 30s and retest those summer 2024 levels. We break down, the lower end of support is going to hold, but we're not back up to the upper end of the range. That's one of those levels to watch. I wouldn't be afraid to take a shot at something like this, finally breaking out of a 3 to 6 month base. That seems pretty interesting, but we'll see. All right. The AES, this is a utility stock. I just want to point out the fact that a lot of the charts I'm talking about, just, thinking about how the markets have evolved here, over, year to date. And in some cases from the February market peak, look at AES, which again, kind of a conventional utility company in a downtrend in the fourth quarter, continued lower into mid-March. This is when the S&P peaked. The S&P comes down over the last month. AES just rips higher. All of a sudden, it's starting to outperform utilities. I mean, some utilities have been much stronger. This is one of those ones that was actually in a confirmed downtrend really until mid February. Now, all of a sudden, starting to improve a little bit with a chart like this. I mean, the question is, at what point, if it keeps going up from here, at what point do you take a nibble on a chart like this, right? Are you convinced that maybe this is the beginning of something further? And I don't know the right answer for you. There are different indicators that can be more aggressive, helping you identify earlier on that this might be an interesting opportunity. The things that are more conservative. I tend to look in this condition like a weekly PPO tends to be my go-to indicator. Something that's in such a downtrend, I usually don't want to touch it. But if you get a weekly PPO buy signal, it usually tells you that maybe something's starting to look better. I did not look at the weekly chart until this moment, but we'll see. So there you go. Just giving a weekly PPO. So it was probably 2 weeks ago, a week or two ago, when it maybe a week ago, probably based on the chart, I would say. So similar, right? I mean, this is a weekly chart. This is pretty long term, and we can do the unadjusted version. It's probably a little better. But you can see here, yeah, this kind of signal where the PPO is very low and then finally registered a buy signal does not happen often. We've only had 3 of those in the last 7 years, and they've been some pretty significant lows. So, it's interesting with some of the utility companies, very defensive, starting to show similar signs to previous lows is something that came to mind as I saw that was a name that was up today. Within financials, I highlighted some of them getting a bit of a bounce. DFS is one of those that is not. Actually went down almost 7% today. Did close below the 200-day moving average for the first time since the end of last year. The end of 2023, that is, beginning of 24. So again, if this is able to hold, if we get a nice, bounce back day tomorrow, that could be very encouraging. However, again, I'm concerned by charts like this that were in such a consistent uptrend, failing to hold the 50-day, now failing to hold the 200-day. That to me speaks to further deterioration. I'm immediately looking left on the chart and finding those lows, from spring, summer of 2024 as a potential downside target, given any further deterioration. All right. Thanks so much. All of the questions, as always, great conversation happening. I appreciate all the comments about so many things here. Now I'm trying to filter through legitimate questions that I think would be helpful for us all to review. But I appreciate you guys keeping it interesting and bringing a smile to each other's faces, including mine. Let's see. FFTY, thanks so much for watching. You said, what are the ultimate signs of capitulation to the downside? That's a really interesting question. That could be the subject of an entire hour-long webinar, if not a day-long seminar. But I appreciate the question. What would be signs of capitulation, right? So when you think about what capitulation implies, I always think of it. It's a horrible analogy, but I just think of it like a puking out, right? And the famous story about capitulation comes from Walter Demo, who I mentioned earlier in today's episode. And I'll give a brief version of his awesome story. He said, he's a portfolio manager at Putnam Investments in the 1970s. Think like the 1973, 1974 absolute dog of a market. Eventually hits a low, but I mean, it was a brutal market for equities. And a portfolio manager came in his office and said, all right, market's down again. Is it time to buy? And Walt said, nope, it's not time yet. And the portfolio manager leaves the office. And then he comes back again and says, is it time now? We're down again. And Walt says, nope, get out. It's not time yet. Comes back a third day. All right, now we're down again. I mean, is it time? And he goes, no, it's not time. And the portfolio manager says, Walt, I've been coming in here every day. Like, at what point is it going to be time to buy? And he says, it's time to buy when you stop coming in here and asking me what time it is. Like, when you can't imagine the idea of buying the market, right? Buy when there's blood in the streets is a famous quote about it. So, when I think about capitulation, there are degrees to that, right? I mean, ultimate capitulation, like a real capitulation moment, happens in a downtrend phase when the markets are in a period of deterioration. It's so obvious that we're in a downtrend. No one can imagine really buying them. I'm thinking major generational lows, like, great financial crisis kind of moves. We haven't seen that yet. We've seen just a 10% decline, which, as bad as that is felt, is really more of a garden variety pullback. If you look at market history, that's actually pretty normal. Even during a cyclical bull market phase, you kind of get that. The problem is when we start going down further than that, and when people start to accept, right? We're still in the disbelief phase where we've sold off, and I'm still hearing people say, all right, that was the low. We're probably going to bounce from here. And they might be proven right. But, in my experience, you really don't want to turn that bullish until people stop thinking that we might actually be going up. That's when it is a protracted decline. That's when it's like a 2022 kind of market where you just want to be out of the way. Then we can start looking for larger signs of capitulation, right? Real signs that, things are getting absolutely puked out, where less than 10% of stocks above the 50-day moving average, most stocks below their 200-day moving average, a lot of things oversold, a lot of things dropping below support, lower highs, lower lows, all those things around. But then you start to get divergences, right? You start to get bullish divergences. Those are signs of capitulation in my mind, which are things that are so negative. And then you start to see some signs of accumulation where, like, early investors are trying to buy into things. In the short term, with like what we've experienced over the last week, if you're talking about that kind of capitulation, I'm looking for oversold conditions. I'm looking at where we're at relative to key support levels. I'm looking at leadership to see if you see things that have been beaten down that start to bounce higher. Those are some of the short-term capitulation signs. Breadth indicators getting short-term very negative. Bullish divergences in some of those. Buy signals from indicators like PPO indicating that we're now starting to see accumulation. Those are signs that the markets are really negative. And volume is a big part of that too. I mean, big, aggressive volume to the downside, showing that everyone's kind of selling on. Big gaps lower, which are called an exhaustion gap. Those are things I really haven't seen yet. I'm still seeing sort of like early stage bear market kind of configurations. So that was a very long-winded way of answering your question. Of there are different things, and I think if we would continue to go lower, you'll hear me dust off the bear market bottom checklist. I don't think we're there yet. I think it's a little premature to be digging that out. But again, general thing is when it feels like people are stopping. You don't see the optimism that you see now. I still hear people talking about how that was the bottom, and then for me, that tells me we're probably not there yet. So there you go. There's my short answer to the question that you asked that I went through there. Truth will always prevail. I appreciate you watching. Have you looked into the Kopic curve lately? I mean, I have, right? So I mean, that's part of my the market misbehavior live chart list, which, by the way, you can access at marketmisbehavior.com/charts. You can get to this list of charts. I keep them updated on the stock charts platform. It is the last chart on the list is the Kopic curve. It did start to turn lower, but I would tell you, careful on that one. I mean, number one, you're right. The Kopic curve has started to turn lower. Is that a big sell signal? Not really. And Sedge Kopic, who created this decades ago, did not include a sell signal. For him, it was a buy signal, and that was it. He designed this as a way to confirm that a market that had been in a downtrend was no longer in a downtrend. He was looking for signs of a bottom and confirming a recent low. So using it for what you're suggesting, which is the Kopic curve starting to turn lower, not as helpful. However, if you look at some recent cycles, it's actually been pretty good at helping you identify some turns. So you're not wrong. But I tend to use the monthly PPO as the alternate version, as a sell signal version of the Kopic curve. It's not quite there. At the end of last month, it wasn't giving a sell signal. This is something I will definitely be watching going into the end of March. So if you want to keep an eye on that along with me and see how it goes, go to the Market Misbehavior live chart list. Again, that's marketmisbehavior.com/charts. This is the final one on the list. A bunch of other really cool charts to watch between the first chart and that last one as well, though. Hey, folks, thanks for some awesome questions. As always, I appreciate you so much watching and keeping it interactive. Thanks so much for supporting me and Market Misbehavior. It is a lot of fun to do this show. I enjoy it a great deal, and I enjoy reading your comments and interacting with you guys as much as I can. So have a fantastic night. We'll be back tomorrow for our next update. Happy St. Patrick's Day. And remember, it's always a good time to own good charts. Have a good night, folks.